got action. Okay, so a little while ago we were talking about how a lot of people view trading as gambling, right? Like a lot of people on the outside are looking in and they're saying, man, how do you guys make money, inside of this market? Isn't it just random? And it's the furthest thing from random. Everything in this market happens for a reason, and it's just up to us to figure out exactly what's going on and use structure and basically price action on our side to figure out exactly what's going to happen next. Like, I love the quote that Steve Jobs says is, you can't connect the dots looking forward. You can only connect them looking backwards. And everything we need to make money in the future has already happened behind us. And it's up to us to just find the levels and continue to execute based on the different zones of support, resistance, supply and demand, different Fibonacci levels. So everything that we need, like I said, is already there. So I see we got like one question in there about the pending orders, stops and limits, I believe. So when we say pending orders, how many indicators are reasonable to track and get confirmation? Man. So listen, I think a lot of people, that's a really, really good question, Ruth. Really good. A lot of people, when they first start trading, they are like so enamored by the whole, oh my God, these indicators, they're gonna help me make $1,000,000. All I gotta do is follow the indicator. When it says do this, I'll do this, and all I'm gonna do is just follow it blindly and make this money. It's it's the furthest thing from the truth. The sooner you start to get away from the indicators and start to just use actual price action, the better off you will be, because you won't be depending on anything in order for you to make money in this market. Now, for me, I think starting off, certain indicators that would benefit you, maybe the RSI, the Bollinger Bands. A lot of people like using the stochastic or the MACD, or I've even seen people use the ADX and things like that. Most of the time, those, like the stochastic, the RSI, and the MACD, those three are like the main three that I see a lot of. Those three are considered momentum indicators. Okay, so something like right here at the bottom, we got the RSI. It's simply just a momentum indicator. It's just dictating the actual momentum in the market. It's giving me a heads up of the actual movement that's taking place, whether it be an upwards trend or a downwards trend. And it can dictate like overbought and oversold areas as well. Now, I don't want to see you guys starting off trading with a slew of indicators, right? It makes no sense to have Bollinger Bands up here, and then you got, your MACD and your stochastic and your RSI, and they're essentially all telling you the same thing, right? So if I'm adding on, let's just say we got Bollinger Bands, right? We'll put Bollinger Bands up here, and then let's say I wanted to add on, let's see what else we got. See if I got anything else in the favors. We can add a MACD, right? We got all these different indicators on here, right? Everything, all compounding, right? So everything just jumped left and right. There we go. So if I got all these indicators stacked up on here, essentially I'm filling up my chart with so many things, and I'm hoping that something on here starts to make sense, right? And it's just that you run into a situation. Let me remove all this stuff. I got too much on here right now. Man, way too much. Sorry, guys. Got to try to clear it out for you guys so you can follow along a lot cleaner. There we go. So if I got my RSI, my MACD, my Bollinger Bands, and you guys are looking at, okay, this one's bouncing off the top, I should be getting in for a sale. Okay, wait, this thing's telling me already that's a little bit of growth happening. Maybe I should wait for the buy. You find yourself spinning your wheels instead of just looking at actual price action and saying, okay, the market's sitting in a ranging area. Let me take what I have and simply just box this zone up, right? Find your actual areas in the market, box this up, and now be patient to see what you get from this movement, right? Like you can't overthink this. Okay, because the thing I believe is a lot of people, when you first start trading, you're overthinking everything. Trading is extremely simple. You don't have to do all these different, tricks and loops and swoops to make money here. All you have to do is find your niche and just master it. Another thing is, if you're trading a certain indicator, the settings may differ on different time frames, and that's a big deal as well. So let's say we're using the RSI and we're looking at this thing right now on the daily time frame, and we're looking at the market just kind of range in the center. We can't see it at an oversold area or overbought area. But if I go to something like the 1 hour, now, it essentially changes the entire view of the tool, because now I have to sit back and say, okay, if this is going to show me an overbought area on a 1 hour or an oversold area on a 1 hour, what do I do? And right now, what do we have? Price just came off of an oversold area, slightly pushing higher. what do I do? Do I jump back in and take the buy, or is this just going to be another retracement dropping back down to the downside? There's a lot of things happening at once. For me, I like to keep it simple. So I'll give you guys an example of what I like to do just to keep everything. Let's see. Here we go. Remove all drawing tools. There we go. So for me, I like to keep things incredibly simple. I don't like to overcomplicate anything in this market. I'll show you guys one indicator and then we'll go from there, and then I'll show you why I like to use these. So that way you can have a better understanding of why I use it and what it does. Okay, so let's insert, and where are we? EMAs. Do I have it on here in my favorites? No, oh, here we go. Perfect. So I'm gonna change the settings here to 8. I'm just gonna make this like blatant so you guys can see it like out and out right in front of you. Okay. Now, I like to use this. This is an 8 exponential moving average. And this allows me to keep the market in a sense right in front of me, right? I can understand the strength of a trend, exactly what's happening. And the reason why I use this is back in the day when the Japanese candlesticks were made, which is what we're using right now, these candlesticks you see, when they started trading this, they used this 8 exponential moving average to help them understand exactly what was going on in the overall trend. They call it the T line, AKA the trigger line. It basically showed them a situation where the overall strength in the market was moving in one direction, and it allowed them to guess, or not guess, but estimate exactly how far the trend would go. So right here, we have a nice uptrend taking place, and you can see prices respecting the 8 moving average, like coming down, closing right on top of it. And then finally, we get a candle breaking below. They said the moment a candle breaks this line, the very next candle will let you know which was going to happen. And if it comes running right back up into this, it shows that there's still strength within this trend, and it continue to do what? Move to the upside. Okay. And the same thing happens here. Price broke back down, right? Came up, broke my line, and stayed above my line. What did it do? Continue going higher. It didn't come running back below. It stayed above. This candle closed right on the line, and we continue to the upside. Now, right here, we had a break of the line, right? Price closed above, and what did the next candle do? Closed right back below and continued our movement to the downside. So this line for me actually makes a lot of sense when it comes to just seeing the overall strength of a trend and making it a lot simpler to gauge the strength and how long you can stay inside of a movement as well. All right, do we have any other questions as well? Hold on one second, let me unmute you, Jay. There we go.
Yes, sir. So, yep. Hey, that was amazing, man. That moving average, Sean. That's a really good one. Another question that we have is, do you use? The comments is coming in fast. It says, do you use most desktop or phone to trade? What's a good setup for desktop, or is 10 tabs open just the best?
Okay, so I prefer the laptop over over my phone. Now, don't get me wrong, the phone is really convenient, but once you start really getting deep into trading, your phone just won't do it. It just simply won't cut it. I mean, you're going to run into a situation where you're going to be really doing your thing. You're going to start understanding the markets. You're going to mark stuff up. You're going to analyze things. And that phone, having that little bitty screen and not being able to really utilize all the tools and functions inside of your actual MetaTrader 4 or something like TradingView is going to put you in a situation where you're gonna be very, very, I guess you're gonna be very, very frustrated because you can't get enough information on your chart. And it's just that I don't want you guys to really kind of like, depend on, the phone, because I think the phone is easy when you're just copying and pasting. That's one thing with the phone that makes it a lot more convenient, where, okay, you got to trade from, swipe trade, you can copy it, paste it. Awesome. Fantastic. Very efficient. When it comes to you actually entering and exiting a trade, monitoring this market, understanding the certain price levels, having the different time frames right in front of you, you can have multiple screens. I mean, being a professional trader or taking trading serious, it really requires you to have a really good setup. Okay, even Christopher Terry talks about it. Like, if you're going to be serious about this, invest in your tools. Get you multiple screens, set up your laptop. Even if you don't even have the money to go out and buy multiple screens, simply just sit down with your TV, plug your laptop into the HDMI port, hook it up to the TV, and I'm telling you, it's a game changer. You see everything in the market. I got multiple screens, and I got one here, and another one over here with the tablet. So it allows me to see so much. I can have multiple time frames up and look at everything I need to see based on whatever entry I may be ready to take at that time. So for me to you, laptop is always going to be, you know, king over the phone. Always.
I would say with the laptop and the phone is that how I personally use it is I do heavy markups, and I use the laptop for any indicators that I have that I want to monitor the charts with. But then I will probably most of the time I execute on my phone the trade, or I'll monitor my trade throughout the day from my phone. But I'm in the process of getting a laptop that can fold into a tablet, so I can just take the laptop everywhere I go, but then still use it as a tablet.
Absolutely.
But a lot of people can't do that right now. So if you have a phone, monitor the trade. If you have to go away from your laptop, but do heavy markups and use your indicators on your computers. Yeah.
Nice. I'm also going to answer that. I'm going to go back over there for you as well, Chanel and Kim. I'll make sure I go back over it and be a little more in depth with the explanation. Andrew sent me a question privately. I believe he said, have I ever seen the MTFA indicator? No. Could you be more specific of what it is? I may have seen it. It may just be in a different name for me. But for Chanel and Kim, this is one of the reasons why, like I said, with this with this 8 exponential moving average, I'll go over a real quick description one more time. The Japanese traders used to use this. They called it the T line, the trigger line for another name. It just allows them to gauge the overall strength in the market. And this is just a real simple 8 exponential moving average. Exponential is a lot different from a simple moving average because exponential is putting more emphasis on the first few candles instead of just giving you a simple, flat out ranging, you know, overall of what's going on. And a moving average simply just basically calculates the open and closes of the whatever period of candles is counting. So right now, this is counting 8 candles in the past. Whatever those open and closes are, is averaging out those opens and closes and giving us whatever price level right here based on this line. So right now with the exponential, it's averaging it, but it's putting more emphasis on the first few. So maybe like the first 2 out of those 8 or the first 3 out of those 8 are being more emphasized inside of this 8 exponential moving average. And you can see as we move along and what's happening right now with this, like even when the market's moving downward, this was a very strong downtrend. And you can see every time price broke our level, let me remove it so you can see. Every time price broke the 8 exponential moving average, what did it do? Came right back down. Like they said, when you get a break of this line, right, the next candle is going to tell you exactly what needs to happen within the trend. So after we start seeing the price break lower, right, we going low, we had a low, we made a lower low, price is breaking lower, breaks to 8, does what? Come back down. Breaks to 8, comes back down, continues to drop, breaks to 8, closes back. And when I say breaks to 8, all I mean is that a candle was closing on the other side of the 8 exponential moving average. All right. And as we start to see it drop lower and lower and lower every time, what do we have? What happened here? Price broke to A, a little bit of pausing with this doji candle here, came right back down, pushed above, and now we have multiple candles closing above. This is a signal that this trend is now weakening, and we can start seeing consolidation or a reversal. And what happened right after this? Consolidation, right? And a little bit more of a drop off that we have right now. So we're not seeing anything dramatic happen in the market, but just simply following something like this can help you along, especially when you're in a trade that's already profitable and you want to make sure that you stay on the right side of it. All right. Let's see. What did you say here? With the 8 moving average, will it affect my 100 moving average? Oh yeah, you can use both as well. I mean, the 100 moving average is really, really good when it comes to, you know, seeing what's going on in the grand scheme of things on a higher time frame. Like something like the daily, the 4 hour, even the 1 hour, that's great. But like think about it in the sense where you're trying to find like a really good entry, you can go down to something like the 15-minute, and now you have all this information in front of you that's giving you a really strong heads up about, okay, what do I need to see next? And when we combine it with other indicators, because I'm not showing you guys this is just like end all be all, right? This is more of a, okay, you combine it with different things like anything you use, and you want to make sure that it's going to make sense all together. You want to have confluence. Confluence is just another way of saying multiple confirmations lining up, putting you in a position of confidence so that you can jump into a trade and know that you have structure and you have momentum on your side. Okay, so in conjunction with something like the 100 moving average, yes, as well as using this on a lower time frame, absolutely. So let's see if I use something else. Like, I'm just gonna go ahead and layer this on so you can see what I mean when you use it with another indicator. Because we're just gonna talk about. I want to show you guys why indicators aren't everything, but they can be beneficial if you know how to use them and you don't kind of fall into the bias of allowing them to make all the decisions for you. I'm gonna go ahead and like alter this, and I'm gonna show you why I keep my settings the way I do with my RSI here, here, and let's see, 45, 55, 55. Let's make this blatantly bright so we can see that. Awesome. And we'll leave that there for now. That's fine. Okay. Now, what I'm going to do next is I'm going to drop a line on here so you guys can see what I'm talking about. This is going to be like at the 90 though. Okay. Done. And one more on the 10. Okay. Okay, sweet. So essentially right now I have my overbought, oversold areas right here on my chart. And you can see pretty much when price is getting up to the top of these areas here, and I'm starting to get touches of my overbought zones, I'm looking to see if I have multiple closes below my 8 exponential. And now just because I had an area here where price reached an overbought area, essentially now once this breaks, I can see if the market's going to start to weaken, drop off, make lower lows. And now I can say, okay, now we're in a downtrending market. I can make a better decision from here. Same thing here. I had a touch representing an oversold area. I just have to be patient to see if something breaks my trend line, my 8 moving average. I'm sorry. And from there, I can make a decision from there, deciding if I want to go to the upside and see if we make higher highs from that standpoint. And the situation goes over and over, right? Something comes up, taps my overbought area. As soon as something breaks my eight exponential, now I'm looking to see what we can get from there. And now we got drop off. And the same thing happens here. We got a touch here of the oversold area. I'm looking to see, and now we have a break. This could be a potential bounce pushing right back up to the upside. So just having simple things like this are going to put you in a more confident position. But this isn't all I'm using, right? And then we're only on a 15-minute time frame. If I'm looking at the overall trend, I have to go to find my absolute highs and my absolute lows. You want to always have structure on your side, and then whatever the indicators give you from that standpoint, it'll start to make a lot more sense. Okay. And you can just see like how we use this. Like we get a touch here, and this is just a high leading to a higher high, and this is a high leading to a lower high right here on our RSI. Okay. And RSI just simply stands for relative strength index. So all this is doing is showing me that the overall strength inside of these two pairs is starting to shift. This was a high leading to a higher high. So I'll give you guys an example of what I mean. High leading to a higher high, right? And now here we have a high leading to a lower high. This is divergence because the RSI stands for relative strength index. It shows me that the strength in this market is starting to drop off, even though it's making a higher high. And what did it do? Broke my 8. Already showed me that it was an overbought situation, wanted to drop lower. And now we get the movement we're looking for. All right. Same thing back here, right? We had a low going to a lower low. So follow the movement in the market. Oh, there we go. A low to a lower low, right? And go right back to our RSI from the lows, right? We're not going up here looking for it. We got to connect lows to lows and highs to highs. So now we have a low to a higher low, right? We got a low here, making a higher low, low, lower low. So now essentially down here, the strength is going from bottom higher. Even though we push lower on the chart, the RSI is showing that the strength in the market is already making a higher low, pushing to the upside. So now we're not going as low before. We have more strength, meaning more buyers are showing up, essentially making this area a lot stronger. Now we have a low, higher low, showing that strength is coming in. And now we get a break of our 8. And now we start to see the growth that we're looking for. Okay, so these little things like this will start to benefit you along the way when you're trading. And now we're on something like the hour time frame where it makes a lot more sense. So now when you see this, you can go to the lower time frame and start finding those real correct entries as well, using something similar on the RSI and using your 8 moving average.